there's always a fear that the dollar is going to go away. It seems every couple of years this comes up and it becomes a big issue, and it's usually always China that's going to be the new currency, the yuan, or now the BRICS or something like that. But what's fascinating to me is the reason the United States is the world's reserve currency is because of the way our country is built, with private property rights, rule of law, and a functioning democracy. We're one of the few countries where people are actually trying to risk their lives to get into and not out of.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey, welcome back to another episode of the Ducharme Wealth Management Podcast, where we aim to provide some education and insight so that our listeners can have better, more meaningful engagements with the financial professionals that they need to engage in their life, whether it be their financial planner, investment advisor, also their attorneys, their insurance people, whoever it may be that's you need to hire and could impact your wealth. So today we have a super special guest on. I don't know, we have a lot of special guests that are super special. But today we have Strider coming on, Strider Elass from First Trust. He's a senior economist there. First Trust is a massive firm. They are ranked the number 2 firm for economic projection and forecast by Bloomberg. Strider's been, again, he's a senior economist there. He's been there for 18 years and really sharp guy. They do some really good research, and today I just picked his brain a little bit about some of the stuff going on in the economy, inflation, the Fed and the interest rate environment, the incoming administration, the political environment. Talked about Elon and Vivek running DOGE, or the Department of Government Efficiency. So hopefully some interesting stuff, and hope you enjoy the show. I was explaining kind of a process our producer was asking what I was working on and this morning, and I try to form sort of a macro thesis and kind of always have a decent macro thesis in mind that I use not as a allocation tool, but as like a guide, if you will, right? And one of the things that I've learned is you don't want to be drastic with that. You don't want to say, well, small caps are undervalued relative to their historical performance. So clearly, in the next 12 months, there's going to be some kind of mean reversion. And now that Trump's been elected, that's the catalyst. So we're going to buy all small cap stocks or something, right? You got to be very measured in your changes and allocations. And then I roll forward with that, like I was saying, and just use price and a lot of technical analysis, and try to look at prudent risk-adjusted returns when it comes to managing portfolios. But the current environment is like really interesting from an economic perspective because the Fed is now in this cutting cycle. Trump just won. Republicans secured the House and the Senate. And inflation is starting, just had a hot print in inflation, and things are just a little bit, dicey. You have, somewhat extended valuations in the market. Tech is kind of rotating out. Tech isn't in favor, I would say, which is a huge piece like the S&P 500. I'm really curious to hear what your opinion is on all of this and what you guys are thinking over at First Trust. Is it okay if we start with the Fed?
Yeah.
Okay. So they're cutting. Give me the update. Where are they at, and what do you think they're doing and looking at and considering?
Yeah, well, when I look at the Fed and what's been going on, I think they're moving too quickly here. There's no need for them to cut rates by 50 basis points in that very first meeting. And I think that's put them in a little bit of a pickle here, because now instead of every meeting being just 25 basis points, now it's either 25 or maybe even nothing, because the reality is that we have not seen the inflation measure come down further. It's actually stabilized and it started to increase to some degree. I think it will over time continue to fall, but again, I think it's very important for the Fed here moving forward to be more cautious because economic growth is still fine. Employment, although slowing, is still growing, and inflation is the other side of the mandate, and that has not hit their 2% target, even though they believe it will continue to come down in that direction.
It's, what's the risk of them going? Uh, what's the risk of them going too fast? So if inflation's sort of stabilized and they come in December and they hit it with another 25 basis points and they continue to lower rates, what kind of implication does that have? I mean, does that, like, some people just would view that as, that's just going to be easing conditions and pump the market, and you know, all is great in the world if your asset prices go up.
Well, yeah, I mean it is great in the world if you have the assets, but I think one of the big things that the election especially showed that we just went through is that even though from an overall perspective of economic growth and from the reports that we've seen, I think we live in a big uh, a world that's a dichotomy right now where the rich have done exceptionally well, even though they had to pay higher prices for some stuff. They own majority of the assets and they've seen those assets explode higher, while those on the lower end, I would argue, have been in a recession over the last couple of years because they have very little assets, and we've seen prices go up tremendously for everything that they need on a daily basis. And so they're just trying to make ends meet, and wages have not kept pace over the last couple of years with the inflation they've seen, especially in gasoline prices and rents and food prices. I mean, across the board. And so, what I think the election really showed was that no, things aren't great as many people believe they are. If you're wealthy and have a lot of assets, and it's been great, but those at the bottom have been absolutely crushed by inflation. And I think that's the biggest moving forward here for the Fed. The biggest risk that they face by cutting too quickly is to see inflation reignited. And if we start to see inflation come back strongly, that's going to be a huge problem. And especially it's going to hit those at the lower end the most.
Yeah. With the way that inflation has trended down, and it came down quite significantly, right, in that historic hiking cycle. Um, it peaked out, what it peak out over 9%
Yep.
on CPI. And now it's down to what are we printing like recently, like 3% or so.
Yeah,
Uh,
a little under three.
and historic target at or the kind of the historical target, it has been 2. And I've heard it called like the last mile. Like the last mile to get it from 3 to 2 is like a really big lift.
Sure.
And one of the things that I keep coming back to in my head was actually something Brian Westbury said when I had the chance to speak with him in Vegas this last year. Was he equated it to like a campfire. So if you start a campfire and it's your first day in camp and everything's wet and you try to light the fire, you eventually get the fire started and it burns really hot, and then you end up with a bunch of coals, and then you can look like the fire is put out, and you can even put maybe a little bit of dirt over the top or something, but you can come back a little bit later or the next morning, and those coals are still so hot that your fire reignites really easy, right? There's already a level of heat. There's already stuff burning. And so it's easier to get the flames going again. And that's what he felt like inflation was sort of doing, right? Like that last 3%, going from 3% to 2%, it feels like inflation's, become a non-issue. Like we've, defeated it, or whatever however you want to describe that. But that the coals are still hot, right? And so if I'm hearing you correctly, you're saying if the Fed goes too fast, there is a significant chance of them reigniting inflation, which would be really bad for, it potentially good for asset prices, bad for the general population in the economy as they, deal with day-to-day life and trying to, work and make ends meet.
Yeah, and I think also if you're looking at interest rates in general, they can only control the short end. And so if all of a sudden people believe that either economic growth is going to pick up dramatically or inflation is going to pick up dramatically, the long end of the curve could go up tremendously. And they're trying to bring the long end down, especially to help housing. And so that would be doing the exact opposite. So uh, time will tell, obviously, but I just think they shouldn't move as quickly as they are. There's no need with where things currently sit today. I'm not sure why they're as aggressive as they're being. Do I believe they should be cutting today? Sure. But I just don't believe they need to be cutting very aggressively moving forward here. I think there's a lot more time that there can be wait and see moving forward here.
Yeah.
But just as what you talked about with what Brian Westbury said at the conference you were at in Las Vegas, very true. I mean, there are embers still burning for inflation today. And if you think back to the 1970s, where we had a massive inflation bout, several times they believed that Arthur Burns, the Fed chair then, thought that inflation was low enough that policy could start to become easy again. And every single time he did that, we saw inflation come back with a vengeance. And it wasn't until Paul Volcker came in the early 80s and really said, look, I don't care what it takes, whether we have a recession or not. I'm going to break inflation's back and let interest rates go where they need to go. And that's exactly what we saw. And that's how we got out of the inflation. Now, I think things are a little bit different today. But again, there's still the potential that if the Fed does move too quickly, that it could have a dramatic impact on where prices head from here.
I think there's two things I want to talk about as a tangent to that. And the first one is the yield curve, right? So people always talk about the Fed's lowering rates or the Fed's raising rates. And I hear this a lot actually out of the real estate community. And they're kind of, almost belief that the Fed controls all interest rates almost, right? And I'm I I'm trying to wrap my head around this. I like the words you used earlier. Like the Fed is kind of in a pickle because the way I'm synthesizing this data, and so correct me if you think I'm wrong here at all, please. If they hold rates high, eventually the yield curve has to come up because if I'm going to buy a 10-year treasury or something like that, I want to have a positive term premium for the time of that relative to having a money market fund or something, right, or a 3-month T-bill. And so if the Fed doesn't lower rates, eventually the long end would have to come back into contango, basically, right, in the yield curve. If the Fed lowers too fast, though, and inflation reignites, the 10-year and the 20-year are still, like, they're pretty high relative to where they were a couple of years ago. They certainly haven't come back down to where people would like them to be, which, hey, I'm no different than anyone else. I'd like to borrow money for 20 years at 1%
Sure.
or 2%, right? But I don't think they're going back. So if they go too fast and then inflation comes back and you have a sell-off in the yields similar to the first kind of round of sell-offs, that really pushes interest rates really quite high on the long end of the curve. And so I'm having a hard time seeing, well, in what scenario does the long end of the curve actually come in and be in contango, and where does the Fed rate really end, and where do long rates really end at? Because buying a 10-year treasury at 5% sounds like a really good deal until it goes to 6%, and you were a low risk investor and you had 7 years of duration. You just took a 7% loss, on your principal,
Sure.
right?
Yeah. Yeah. So looking out, I mean, again, completely agree with you. The Fed has very little, if any, really no control over the long end of the curve. It's really looking at macro conditions moving forward, thoughts on economic growth and inflation. And so the Fed can cut, But I think what we saw just even after they did their first cuts in back in October, where they cut by 50 basis points, the 10-year yields moved up substantially. And people in real estate, again, I completely agree with you. I think they believe if the Fed's cutting, that means that they're going to be able to all of a sudden get lower mortgage rates. But with the 10-year having a almost perfect correlation with the 30-year mortgage rate, I mean, I don't believe that rates are going to come down anytime uh, in a substantial manner anytime. I wouldn't be surprised if over the next 5 years we see the 30-year fixed mortgage rate hover somewhere between 5.5% and 6.5%. So better than where it is today for sure. But again, that would mean that the 10-year would come down to some degree. But I think the 10 year is going to finish somewhere more around 3.5%. So look, to me, I think you can extend duration to some degree here. I'd go out maybe to 7 years. I'm even comfortable with 10 years here. And if you're able to lock in a 4.5 or 5% 10-year treasury over the next 10 years, I think that will be a good trade because I do believe that the 10-year will come down further. But we're just getting more towards normal rates where they were. You really take out that 15-year period that we went through, where interest rates were basically zero and the 10-year treasury was hovering, between 1 and 2.5%. I think we're now just normalizing. And so I think gone are the days of 2%, 3% mortgage rates. And the good news is that majority of the public locked in those very, very low interest rates. In fact, if you look right now, about 60% of mortgages outstanding are locked at 4% or less, and those are all fixed rate mortgages. So that's a wonderful thing for people moving forward here. But again, I think if you're waiting for mortgage rates to come down substantially, it's just not going to happen anytime soon.
Yeah, I think wonderful for who though is sort of my question on that. Two thoughts I have about that is, yeah, all those mortgages they exist and they're out in the mortgage index funds. They're securitized, and so now there's these bonds with low yields on the coupon, low coupon payments and high relative duration risk, or duration high relative to the coupon. And I don't know that that's favorable for a lot of people's portfolio if they just own the mortgage index. And then my second thought is, what's your take on that being like? You heard like the lock-in effect, right? So people are now unwilling to basically move. And I'll use myself as an example. I mean, on my home, I have a mortgage rate at 2.375%. It's like free money almost. And I don't want to move and give that up. And I certainly don't want to move a couple blocks down the street for a slightly bigger house or newer home or something, and go from 2.375 to 7. And 2.5 times my interest expense. So I just stay put, and we're quite happy, and we have no intentions of moving, right? But now all these people have done that. And one of the interesting things somebody pointed out to me is that it's quasi almost like rent control, because, just like in these big cities where they impose rent controls, and so people would just, because they would never move and they couldn't have their rent raised or raised more than just an incremental amount that ended up being, lower than the inflation costs and appreciation of the real estate itself, they ended up with like these great deals on rent that they just sort of couldn't move, because if they eventually moved, they couldn't afford anything at market value. And so now that same sort of thing that happened in rent control that was bad for housing has happened in home ownership, right? The same type of thing. Do you think that plays a role in housing prices going forward, and the attainability of housing for the general population?
Yeah. So in terms of your first question on just buying mortgage index, I would definitely, especially on the fixed income side, you definitely want to be looking more for actively managed um, fixed income funds, I would say. In terms of housing, there is this mortgage lock-in effect, and it's been incredible for those that own homes. And again, if you look, uh, a lot of people are worried home prices are going to come crashing down because they're sitting at record highs, higher than we were back in 2006, 2007. And we haven't seen this this big correction, and people wonder are kind of scratching their heads why. And the reason, really, I believe, is it's that mortgage lock-in effect. You think back to 2006 when interest rates were rising, and all of a sudden, these people that put very little money down on their homes and had these 0% interest rates that all of a sudden adjusted higher, they can no longer afford those homes. So they had no money, really no skin in the game. They just let those properties go. Banks took them over, and we had massive inventory builds. While at the same time, demand fell off a cliff with interest rates rising. So that was then. And if you think back then, almost in 2006, 40%, 40% of interest rates or of mortgages back then were adjustable rate mortgages. Today, when you take a look, about 4.8% of mortgages outstanding today are adjustable mortgages. 95.2 are fixed. And as I said, where it gets really interesting is you look at what these interest rates are fixed at. We have about 26% of mortgages outstanding that are fixed at 3% or less. Another 34% are fixed between 3 and 4%. So 60% of mortgages fixed under 4%. Add in between 4 and 5%, another. So 75% of mortgages are fixed at 5% or less. Makes it very hard, just as you said, for you to be willing to sell your home. I'm in the same situation. Makes it very hard to sell your home to buy an equivalent priced home where all of a sudden you might be paying double or triple what you're paying before. It just doesn't make sense. And so when I look at home prices moving forward here, I don't think we're going to see massive declines in prices. I don't think we're going to see massive appreciation in prices either, but I do believe we'll see gradual appreciation nationwide over the next couple of years. Because reality is that although demand has come down substantially for housing, at the same because of higher interest rates, at the same time, inventories have come down substantially too because nobody's willing to sell their homes. And so I think supply and demand are pretty much in line right now. And even if moving forward here, the 10-year comes down, the 30-year fixed mortgage comes down, and demand starts to pick up. I think once demand starts to pick up somewhat and interest rates get low enough, there'll be those that want to sell that will be willing to maybe take a 0.5% higher on their mortgage payment than they were at before or anything like that. So again, I don't think supply and demand are going to be out of whack anytime soon. And so I think the housing market's going to continue to eke out small gains moving forward here over the next couple of years.
Uh, I, uh, I think that's generally in line with with kind of my belief, right? I think the small concern that I have about housing long term is the demographic shift in the U.S. I think in the coming years, I think we'll continue to see that demand push, but long term, I think there's potentially some demographics concerns brewing, right? I don't think quite as significant as they're dealing with like in Japan and their housing market, but it'll be interesting to watch over this coming decades. Do you have any like thoughts on that at all?
Yeah, actually, I look at demographics as a tailwind for housing moving forward here. If you
Okay.
look at the largest generation of people alive today, it's millennials, and millennials are now moving into their prime working years and prime housing formation years too. And so, although there's a lot of older people who are now retiring or downsizing, I think there are plenty of millennials that will now be buying homes moving forward here that will make up for that and more for housing. So I'd actually be more optimistic on housing over the next decade
Hmm.
than not because of demographic shifts.
Next decade. So when I was saying, so I'm thinking like 30 to 50 years out. You think your thesis is still in line with like a 30 to 50 year time horizon? Like I'm talking significant time out. I know
Yeah.
it's like I mean it's just a wild, like anything could happen in the meantime,
Well,
but
we can come back here in 30 to 50 years
yeah,
and we'll see who
it's
was
like
right. But
well yeah, no.
I would tend to think that things will still be fine. I think immigration will continue to be strong in the United States. The
That's
U.S. is actually one of the few countries in the next, not one of the few, but one of the few bigger countries in the next couple of years or in the next 50 years that's going to continue to grow population and not actually see it shrink. China's population is now starting to shrink. Japan's has obviously been shrinking for a long time. India's is set to grow dramatically over the next 30 to 50 years,
Hmm.
but the US is actually set to grow, I believe it's by about 30 to 50% over the next 30 to 50 years too. So
And that's
all of that combined, population growth, and on top of that, we have been building homes, underbuilding homes for a considerable period of time. I
yeah.
think demand will outstrip supply for the foreseeable future, and unless building conditions change dramatically where we start to overbuild in a massive way, I think we will continue to see price gains moving forward here. But over the next 30 to 50 years, I think prices for homes will be a lot higher than where they are today.
Uh, so two things that popped in my head is, uh, I hadn't really, I don't think I really considered the effect of like net immigration. But then that led me to, man, what do you think the impacts of the incoming administration's, stance on immigration and illegal immigration and migrant workers? Tom Homan, I think his name, Tom Homan, I think is his name. Talking like, hey, if you're an illegal alien in this country, pack your bags. And all the tough talk, which I I'm not here to have a political conversation whether that's right or wrong. Uh, but I'm really interested. Like, what do you what's your thoughts as an economist? What impact does that have on the economy if we actually do, get the borders closed off? You stop having the mass immigration, and then you start having the deportation of people that were here illegally. What does that do to the economy?
Yeah. So I'm all for legal migration. I think it's wonderful. It's what America is really built on, in fact. And if you look
Yeah,
at most of the big companies that have ever been created, a lot of them are from migrants that have come over
yeah,
to the United States legally. Where I think a lot of people are upset is that we've had such a huge influx of illegal immigration into the United States over the last couple of years, and that I do believe needs to be dealt with. In the short term, I mean, if we got rid of every illegal immigrant overnight, it would have an impact on the economy for sure. But I think those jobs could be filled as well over time. Um, Looking at where we are today, though, in terms of what's actually going to happen, I think it's going to be a lot less significant than what's being touted today. I do believe we will see a lot of illegal immigrants that are in the United States be deported, but it's going to be more of a process than I think the second Trump takes over, every single illegal immigrant is going to be, pushed out of the country. One, because it would be impossible to do that. But number two, you've got to find them all, and it'll be a huge process
yeah.
in general. So it could have an impact in the short term, but I think over the long term, it's a huge benefit to the United States to have a system that's built on letting in people that want to come into the United States, but letting them in a legal way. And a lot of people say, well, it's really tough to get in legally, and to some degree that could be true. But I think we need to work with that system. And if we want to ease up and allow more people in, make it easier for people to be able to get in. But again, getting in a legal manner, because what we've seen, especially over the last couple of years, and what's really happened is we've put a huge stress on the healthcare system, on the transfer payment system, where we've been funding, taxpayers have been funding a lot of illegal immigration and people coming into the United States that are maybe not contributing to society. Maybe they are, maybe they're not, but most of them are not paying taxes, and so that's an added stress on a system, a government system already that's spending way too much money that is not being funded alone by just taxes coming in, and cannot be funded alone by taxes coming in because the system's gotten so skewed towards transfer payments to individuals.
That leads right into my next thing, which was I was going to actually ask, what does the effect of this whole Department of Governmental Efficiency, the Doge effect, like what could that potentially have on housing if they kind of deregulate a stuff and allow for a boom? Um, but I like more so we're talking, we're transitioning into this whole conversation about the tax base, and the government can't even fund itself on tax receipts. It has to run this deficit. Um, what? I mean, there's been a lot of stuff thrown around. by Elon and Vivek about what's going to happen, and Trump and all kinds of stuff's been said. I think what actually happens remains obviously to be seen, and my hope is, well, not my hope, my expectation is that whatever they say, we get like probably 5% of that. 10%. I'm
Yeah,
not
sure.
too optimistic on the whole thing, and the reason why is because I did work for the federal government when I was in the military, and I've seen how bureaucratic that system is, and
Sure.
how widespread and deep it runs, and it's a mess. They really have a heavy lift. They're two of the most brilliant guys, probably for the job. Wish them well. I hope they succeed and then some at it, but it's gonna be a heavy lift. What do you think the implication of them, like cutting, if they actually succeeded in cutting all that expense, and the bloat, from the government spending, right? What does that do to the economy? Because I've heard people say, well, like they're really concerned because if all these government employees lose their jobs, and part of me says, yeah, it kind of seems like could be short term pain, but also if you took these people that work for the government and they actually went into the private sector where they added net value, through their skill set, and knowledge, or labor potentially, just does the economy grow at with their participation, growing participation in the more efficient side of the economy, which would be private sector versus government.
Yeah, I think it'd be a huge benefit. I think the fears of government workers losing their jobs is a little bit overstated. I mean, even if there's 3 million federal workers, around 3 million federal workers, if all of them lost their job, it would move the unemployment rate up by maybe 3 or 4 tenths of a percent. So nothing too significant there from that perspective. And I do believe they would be more suited in the private sector where they could add to society in a effective manner. But the Department of Government Efficiency, I think, is really fascinating, and to me, it's the most exciting thing that I'm most excited about the new administration because there are so many issues with the size of government, and government has just grown and grown and grown and grown. And if they actually are able to do something about the size of government, and I think Elon is, if there's anybody who could do anything with efficiencies, it's Elon Musk. And he dreams big, and his dreams seem to usually come to reality too. So something to be excited about. But even looking at the math alone, it's going to be a huge uphill battle, especially if they don't want to touch, uh, Social Security, Medicare, Medicaid. If they don't want to touch mandatory spending, right now, if you look at mandatory spending for government, which is basically programmatic spending, and then add into that net interest payments, which we have to make on our debt, and then add in defense spending because we want to be able to defend our country. Maybe you could cut a little bit there, but usually they're not cutting there, they're adding to it. But let's just say you look at those those three areas, mandatory, net interest, and defense spending, and you look at what's left after that, it's only about 14% left for discretionary spending. Just those programs make up 86% of spending in the United States. So if you're not planning on really making any changes there, you have 14% of government spending that you can play around with. Well, looking at projections over the next 4 years, even, you would go through all of that 14%, even if you just want to keep government spending flat. So this isn't even cutting spending. This is just saying, hey, what we spent in fiscal year 2024, we want to spend the same amount over the next 4 years. If you allowed those other programs to grow at the paces that they're set to grow at, the mandatory spending, the net interest, and looking at defense spending, they would eat up all of spending by before we got to 2028. So there'd be no more, you can call those programs, let's call all those mandatory programs, there'd be no more discretionary spending left. It'd be all mandatory spending. So the reality is if the Department of Government Efficiency wants to make changes and wants to actually cut government spending, that's just keeping government spending flat. If they will actually want to see government spending come down, they're going to have to make substantial changes to those mandatory payments. Net interest probably not going to be able to do anything there. They'll have to look at defense spending. I'm sure there's a lot of waste in defense spending. They'll have to look at Social Security, Medicare, Medicaid, ways to make those programs much more
Yeah.
efficient if they want to actually see spending come down. That to me is a huge stretch. But I think even if they were able to freeze government spending, which again I think is a huge stretch, that would be very meaningful. But somebody's going to have to tackle the issues with Social Security, Medicare, Medicaid, and I think no better person to try to do that than Elon Musk. And I think Vivek will be a huge addition for him as well.
Do you think that if they actually got the efficiency increase, they got the deregulation pushed through the system that they want, that would have that'd be a pro growth um, uh, agenda, and it potentially disinflationary, right? Like if I going back to the home example, right? If I face all this red tape in building apartment buildings right now, and because of all this cut down regulation, I can build a home, faster with less red tape, and I can deliver a product, faster and less expensive. That's a net deflationary effect. And so if they just cut down the government spending, but also actually increase the efficiency for the private sector, right, in dealing with the government, does that open up the door for the Fed to actually potentially lower rates in a disinflationary environment? And then that brings down the net interest expense for the federal government in a meaningful way. So now you're not talking about just 14%, but you can also bring down that net interest expense
Yep.
potentially as well. Is that outside the bounds of reality that I'm thinking of here, or is that a hopeful, reasonable thesis?
Yeah, I think it's probably a little bit outside the bounds of reality, but
Okay.
that's what I love about Elon Musk is that everything he does is really outside the bounds of reality. And so there's a lot of potential here and when I look back to when Reagan was president in 1984, he started a commission. It's very similar to Doge, what they're trying to do now. It was the Grace Commission. It was run by a guy named Peter Grace, who was the CEO of W.R. Grace, and they found billions and billions and billions and I mean hundreds of billions of cuts that they could make to government, and they projected out where government would be by 2000, I believe, if they put these into place. And I mean, we would have been in a very, very healthy position. And they went to Congress and they passed very few of any of them. And
Yeah.
so my biggest fears, and I think Elon and Vivek will come to Congress with lots and lots of ways to cut spending. But I think the real difference this time around is will they actually be implemented? And I think a lot of it could be implemented. And the reason is back in the 80s, when you think about transparency that we had back then, we didn't have, full-blown internet. We didn't have Twitter. We didn't have all of these areas where we can actually see the data now. And government is still very opaque. But if Elon and Vivek make it very transparent, which is what they seem to be looking to do, and as Elon says, they start to post all of these things they want to cut on Twitter, and I think the general public realizes what their taxpayer dollars are currently going to. It's going to be very hard for any in Congress, even Republicans that have been entrenched in Congress for years and years and years. It's going to be very hard for them to vote against some of these spending cuts, even if they have parties that or special interests that want these the spending to continue,
Yeah.
because they're going to be looked at as um, um, not for their constituents. If they're voting against these spending cuts, that majority of the public looks on and says, well, these are just ridiculous. Why are we doing this?
Yeah. Uh, okay. I think the last thing I want to get your take on, and then we'll wrap it up here, is
Sure.
considering all the things we've talked about, right? You have, Fed messing with rates, potentially cutting too fast. You have this new administration coming in, right? Republican sweep across both chambers of Congress and the presidency. Inflation, albeit suppressed, but just had some, elevated prints recently,
Sure.
and this dichotomy in the economy, all coupled with, and I'll say the agenda of the Trump administration, which is that America First agenda, tariffs, protectionism, which again, I'm not here to weigh in on whether that's the right move or not. I'm interested in how can I most profit off of the
Sure.
current environment, right? Um, what does this all do to the dollar? Like the dollar, when you look at the DXY or the dollar index, it's been really strong the last several years. It's been an incredibly strong dollar, and it's come down, it's subsided a little bit, but it's still um, you know uh, quite strong, right? People always say like the deterioration of the dollar. It's like, yeah, but it's actually relatively it's appreciated.
Yeah. Sure.
you,
Yeah.
you know,
Yeah. And I think I wouldn't be surprised if we continue to see appreciation over the next couple of years. And a big part of that, I think, has to do with, again, what happened. Everybody looks at our currency and they think about all the money that was printed in the United States and where things have gone over the last couple of years. The
hmm
inflation we've seen, why is the dollar strong? But the reality is that the rest of the world did kind of the same playbook and even did it to a stronger degree. And so, the way I look at the dollar is kind of like think back to your college days. You have to go out and you haven't done your laundry and you're digging through your dirty clothes and you got to find a pair of socks. So you're looking for the least smelly pair of socks that you can wear, least dirty pair, and you find it. You don't want to wear them, but you got to wear them. Well, that's kind of what I look at the U.S. dollar. It's the least worst in the bunch of all the smelly clothes. Nothing looks great right now, but the dollar's still up there, and there's always a fear that the dollar is going to go away. It seems every couple of years this comes up and it becomes a big issue, and it's usually always China that's going to be the new currency, the yuan, or now the BRICS or something like that. But what's fascinating to me is the reason the United States is the world's reserve currency is because of the way our country is built, with private property rights, rule of law, and a functioning democracy. We're one of the few countries where people are actually trying to risk their lives to get into and not out of. And when you look at China, when you look at India, when you look at Brazil, when you look at Russia, when you look at the BRIC countries in general, if you look at where the most millionaires and billionaires are fleeing from countries right now, China's number one, Russia's number two, India is number four, I believe, and Brazil, I think, is number five. They're all in the top five. Those orders might be a little out. I haven't looked in a long time, but in the last year, they're all in the top five of millionaires and billionaires leaving their country. And for people to say, well, this is going to be the currency that everybody's going to accept, that people are going to want, that's going to replace the dollars when they can't hold on to their millionaires and billionaires, where you look at the United States last year, they had the fourth most amount of millionaires and billionaires coming to their country to live in. Uh, I think the story is just completely backwards. And so, although I think there's a lot that can be improved, and our deficit spending is out of control, debt is growing tremendously. It's not to a point where I believe it's the imminent demise of the dollar. In fact, I think that would be if we continue to spend at the rates that we're spending, which hopefully that's not the case. We're probably at least 20, 30 years away from the dollar ever being replaced. And you can't replace a, a, a stronger currency with a weaker currency. It would have to be something that was stronger than the dollar. And for me, that would probably be a cryptocurrency, whether it's Bitcoin or something else like that. That's a whole nother topic, but that's well down the road. So I'd say in the short term, over the next 5 to 10 years with the dollar, it's not something that I worry about whatsoever.
yeah. Okay. It's an interesting way to think about it. The cleanest of the dirty clothes. I like I like that analogy. I'm gonna take that one from you. I will use that,
Use
Shatter.
away.
Uh, yeah. It's interesting. Like I always look at dollar almost like a dollar gold pair, right? Just that negative correlation historically.
Yep.
And gold's been on this run. Is it but it's not a perfect daily correlation or negative correlation, right? So people are saying what is it, is gold sending a warning signal, whatever. And I don't know that that's the case. It doesn't make gold a good or bad asset. Just an observation. I would really like to have you back on at some point, Strider, to talk about cryptocurrency and
Sure, love to
and the
anytime.
effects of that on the economy. I have I've got another guy I know that's like a crypto. He's like a Bitcoin maxi. There's no other way to describe this. He's an absolute Bitcoin maxi. He's lives here locally in St. George, and very. This guy was actually the like treasurer over the city locally and
Oh,
stuff, and he cashed out his pension and bought Bitcoin. And talks about it pretty openly. This was in like 2016 or 15 or something, right? So it's worked out really well for him. But people thought he was like crazy,
sure.
and he kind of talks about what is Bitcoin as money, and what is money, and how do you exchange that. And I think objectively, as somebody, I'm neither a Bitcoin denier and I'm not a Bitcoin maxi. I think I'm just a normal guy. I think I fall into the camp of like normal people that are just like, this is
Yeah,
interesting. And so when it comes to crypto, I don't think like Bitcoin, from what I understand of it, it would ever be logical or reasonable to say, we're going to transact in Bitcoin, right? I'm going to Venmo you Bitcoin. Like obviously that's not exactly how it works, but you're not going to swing by and pick up a coffee for me on the way into the office, and I'm going to pay you back with some Bitcoin when you get here. Just like the transaction costs on small transactions is too prohibitive for daily use. And crypto people will say there's solutions to that, but I don't know that it presents the same strong case than that Bitcoin itself, like actual Bitcoin has. And but then where does it play into like the economics if like Trump is saying that he's going to have the federal government buy a reserve of Bitcoin, so you go to like almost like a Bitcoin standard or something to that effect. How does that all work or play out? So a topic for another day, I think. We'll be here another hour or two,
yeah, definitely.
but I imagine you have some really interesting thoughts on that. Cool. Well, Strider, I know you're a busy guy. I appreciate you indulging my wild ideas and validating some of them maybe, and getting your take on it. So, appreciate it. Would love to have you back on in the future.
Sure.
And
Thank you for the time. Been great
yeah,
to be with you as always.
yeah, I appreciate working with you guys over at First Trust. I think you guys have some really unique stuff, and you guys have some really interesting research, and I appreciate what you guys do and bring to the table.